Taiwan Semiconductor, Johnson & Johnson just reported Taiwan Semiconductor beat on revenue and profit, $1.12, $1.13 per share versus $1.07 expected, $15.47 billion in revenue versus $15.44. Johnson & Johnson also beat on both, $2.80 versus $2.62 expected, $25.53 billion versus $24.63. Both crushed it. Taiwan Semiconductor, though, is down 5% right now, and J&J is up 5%, I believe. Is that accurate?
Let's double check real quick.
So guys, before we go any further, if you're new to the channel, we like doing earnings releases. It gets a lot of traction, it gets a lot of people thinking. But remember, if you have a long-term outlook on stock, you should not focus on beats or misses on the short term, the quarter-to-quarter basis. You should just think about, is fundamentally the business better? Is it fundamentally everything going to be on track? If you buy a business today, if you own a business out there, your business doesn't do the same thing every single quarter, doesn't always grow at the same rate. So give a little latitude. For both of these companies, the question should be, if I want to own these companies for 10 or 20 years, do I think they'll make more money and more revenue 10 or 20 years from now versus today? And if the answer is yes, the question is, can I pay a reasonable price today that gives me a good return on my money? And that's why we use our stock analyzer tool later on, because it allows us then to go sit there and figure out, are we paying a reasonable price today for that future cash flow? So Mo, why don't you pull up you have this Taiwan Semiconductor
So these
report.
are some of the metrics that compare this quarter to the previous quarter, 2022. So net sales down 10% year over year. We had gross profit down 17.5% year over year. Income from operations down 23%. Income before tax down 19.3%. Net income down 23%. Earnings per share down 23%. So it was bad compared to the same quarter of 2022.
Yeah, I mean, everything in the semiconductor business is pretty far down.
And the thing is, I mean, when you compare it to the highs that we came off of COVID, are these, yes, they're big numbers, but are they just normalizing? You know what I mean?
That's a very valid question.
That needs to be answered.
Now, there are reports out there that the compounded annual growth rate for chips will be 10 to 12% for the next 10 years. Okay, but we saw a huge surge in the demand for chips after COVID with everything being done. The question is, was that sustainable? We said in many videos we didn't think it was sustainable, and now it's showing that.
Like here, I'll go annual, and we can go quarter to quarter, but if you look at 2019 revenue, 32 billion, up to 37 billion in 2020, then it jumped to 45, 55, and 73.5 billion. So I look at that and say, okay, even though those numbers that I just said are coming down, it's just coming down to normal. It looks really bad, but it looks bad because we had that big spike. That's kind of the thesis that I'm going
and they're down from last year's second quarter.
Right,
and okay.
Right.
So guys, that's the
should be there.
And that's the hard part about using our stock analyzer tool, because when you have declining revenue, which might be which is definitely temporary, but the question is, where's that bottom?
And where does it stabilize? Yeah.
Where does it stabilize at for revenue for the company?
Like this, in 2019 they did net income of 10.4 billion. They did 32.1 billion the last year. That's massive. That's massive.
You know what I love about these companies? Look at the number of shares outstanding.
Ooh, stayed the same.
That's the thing about Chinese and foreign companies. They tend to not even buy back shares. They definitely don't issue shares a lot, which is wonderful because we don't want our investors to be diluted. We don't want to buy a new company and then them say, oh, we need cash. Let's bring some more investors in. And now I'm sharing the revenue profit with more investors than I first signed up for. All right, so let's look at the 8 pillars for Taiwan Semiconductor. Oh, wow. Okay, pretty and guys, if you have our software, you can do customized pillars, up to 12 of them, 4 quadrillion different variations. But this is our, oh wow, but look at this, Mo. Big difference between earnings and cash flow.
If I'm not mistaken, does Buffett own this?
Was it this one? It might be this one. I think he sold it. But guys,
okay.
I want to explain this. This is our 5-year PE ratio. This is our 5-year price to free cash flow. We want them to be very similar. When the PE ratio is low, it means they're showing more earnings than cash flow. When the PE ratio is lower than cash flow. That might sound counterintuitive, but for the ratio to be lower, they're reporting more earnings. We want the exact opposite of anything. We want more cash flow than earnings. This is a big difference. This means they're reporting about double the earnings than they are the cash flow. That's always a red flag for me. And it shows right there on our main metrics. Yeah, look at this. Net income of 32 billion, free cash flow 16 billion. And I'm sure we did. Hey Tim, do you mind doing me a favor? Can we add 5-year net income to our underneath here? Just like we have 5-year free cash flow. Yeah. So you guys, we're making changes here on the spot.
On the fly.
On the fly. We make changes here for our software to make the user experience better. But boy, that's a good return on invested capital. This shows guys, when they invest money in their business, they get high returns.
And it's getting better because I just went over to Stock Analyzer tool, which we'll go to in a second, but 16 for the 10-year, 16.5 for the 5-year, and 20 for the 1 year.
Yeah, you're right.
We like to see it getting better.
So the hardest part about this company will be determining what are the assumptions we make about the future, because every investment is the present value of all future cash flow. And since we don't know the future, we have to make assumptions.
Yep, that's the hard part.
That is the hard part. Why don't we just jump? Well, actually, let's see what analysts are saying.
Okay.
Analysts are expecting $1.06 in earnings this year, which is down 17% from the previous year. And then this is expensive, Mo. It's a $100 stock.
Yeah.
And they're expecting $1.50 in 2 years.
And the thing I don't like, we're seeing declining revenues and they have increasing revenues going for the next 2 years. Significant increases.
But they're having a decline for this year still.
True.
Only 2.5% though.
But then a huge jump.
Yeah.
So, yeah, I don't know how useful the analyst expectations will be for me with this one.
All right, let's just jump to the Stock Analyzer tool.
All right.
And let's do a 10-year analysis. And Mo, I want you, guys, this is going to be a hard one. But this is why, if you have the software, for $1 a day, you can sit here and do your own assumptions and multiple different assumptions to figure out what makes the most sense to you. We always recommend, don't make the numbers work. Put your numbers in, low, middle, and high. Go to extremes. I don't care if they're extremes, like you put -5, which we won't do here, but -5, 5, and 15. I don't care. The point is to get a range of where you're at. And if the stock is at $100 and the middle price is you need to pay 50, you just avoid it. And that's what we're trying to teach you here. We're trying to get you to save your time. Don't go spending a lot of time on something that doesn't make sense. All right, so Mo.
I was thinking this is going to be low. 1, 5, and 9.
1, 5. You know what? I actually think I'm fine with that. I think 1 is way too low.
It is, but it's an extreme.
And I'm okay with that.
Yeah. What if, I'm looking at it saying...
Actually, you know what? Let's do this. 1, 7,
okay,
and 15.
Okay.
1, 7, and 13, sorry.
Because I'm just thinking, what if they decline for the next 5 years to get back to that stable level?
And then
grow.
And I look at 13. If the chip industry is really going to grow at 10% a year, 10, 12% a year for the next 10 years, okay, maybe they could do 13.
Mm-hmm.
All right, profit margin, which has been increasing.
Yeah, it has.
Oh boy, do I really hate this difference between profit and free cash flow. All right, give me something, Mo.
What about 35, 38, and 41?
Perfect. What about free cash flow?
Oh, geez. I think we should keep it almost half. So maybe
17 and a half.
17. Okay, I was going to say 18 and a half.
20 and 22 and a half.
Sure.
How about that?
Sure.
All right, PE, Mo. Now remember, guys, when it comes to PE, a lot of people will look at the recent PE and price of free cash flow. We just put them up here. You shouldn't base it on where it's at today. You should start at 15, because that's the market average. You should go up based on moat, based on growth rate, based on return on invested capital. That's how you put that up here. The higher all of those are, the more PE you should be willing to pay. As you remember, Warren Buffett started buying Coke at a 30 PE back in 1987, because his thought was, if they raise their price 5% next year, it doesn't matter. People are still going to buy it. Same with the free cash flow. So Mo.
How about 16, 18, and 20?
Okay. And I'll do the same thing for the price of free cash flow. Now, desired return. This is a company that's in Taiwan that has a little element of risk. And for desired return, the higher our return, the higher our growth rates, the higher all these things, we want a larger margin of safety.
11, 13, 15?
I was actually going to go 12, 14, 16.
Fine with that.
Now, guys, remember, we're still going to do Johnson & Johnson next, but this is just an idea of where we stand here. So I look at this right now thinking to myself, low price of 30 to 55, a high price of 75 to 135, a middle price of 45 to 90. If you paid today's price and our lowest assumptions occur, you're going to lose 4.5%. If the middle assumptions occur, paying today's price, you're going to make 3.76. If the highest assumptions occur on today's price, you make about 12%. It's just math, guys. This is just math. Now, obviously, things can fluctuate, PEs, etc., but I look at this thinking to myself, There's so many unknowns about this thing. I'm just going, for me, it's just too hard pile, but it doesn't mean it's too hard for you. We're trying to teach a process here. We're not just trying to say to you, go buy this, don't buy that. Teaching a process. Now, will we say we like this? Of course. Would we say we don't like something? Of course. For me, this is too hard. I'm out. All right? So let's go to Johnson & Johnson and start looking at some of the metrics on Johnson & Johnson. And again, to repeat, they reported $2.80 in earnings per share versus $2.62 and $25.53 billion in revenue versus $24.63 expected. And they are up 5% currently. So Mo, what are you seeing right there?
So their sales this quarter compared to the quarter of last year, 2022, increased 6.3%. Net earnings increased 6.9%. Earnings per share increased 8.9%. So it seems like everything is getting better for Johnson & Johnson. Let's see.
It is currently the second biggest gainer on the S&P right now. By the way, random, Discover Financial is down 15% today.
I saw. This is their segments. Consumer health increased 5.4%. Their pharmaceuticals department increased.
And pharmaceuticals is their number one.
Yeah.
And what's important in pharmaceuticals is pipeline.
So everything got better for them. Good for them. Wow.
Now, this is probably a dividend-paying company, is my guess. Yeah, look at this, guys. So they have a dividend yield of 2.7%, which pays out $11.8 billion. Their 5-year average free cash flow is $19 billion. We want their dividends to be less than 50% of their 5-year free cash flow. But for a company like this, they're probably not growing a ton.
Right.
So what are they going to do with their cash? If the stock is really cheap, I want them buying shares back. But I'm hoping this dividend is probably pretty safe. It's probably a pretty safe dividend because of how big this company is, $435 billion with almost $100 billion in revenue. How has their revenue growth been in the last 10 years, Mo?
Let's check it out. They went from $72 billion to $96 billion over the 10-year period with...
But here's what I don't like, Mo. Look at this.
Wow, big jumps.
But look at this. This is their cash flow statement. There's a part of this called the acquisitions and dispositions line.
Oh, boy.
Look at the acquisitions. $2.4 billion, 9.4, 30.5, 2.55, 6.4, 17. Are they buying growth? That's the question. I don't like, in the last 10 years, they've had, 7 years of multi-billion dollar acquisitions.
Now, this is a big company. I don't really know where they would get growth from otherwise. What do you think about this type of company buying growth?
To me, it's a little misleading on...
So they shouldn't be...
Well, when we make our growth assumptions, here's the problem.
Oh, because we don't know.
Correct, because they're having to spend the cash flow to go buy that growth.
And then what if they just say, hey, we're not going to make any more acquisitions? Does growth just stop?
I mean, look, all those acquisitions, and they still only grew revenue 3.3% a year for the last 10 years. How are their shares? Let's go look at the 8 pillars. How are their shares outstanding? Okay, they're buying back a few shares.
Buying back very few.
High PE, but here, this is where the free cash flow multiple is actually lower than the earnings multiple. So the 5-year free cash flow is 22.9. The 5-year PE is 27.3. Net income has dropped. Cash flow has dropped, bigger than net income. Let's see here. About $100 billion in debt. Good return on invested capital, 12.8%.
Is it weird that I'm almost like, I don't want to own this?
I don't think that's weird. Let's do a stock analyst. Let's see what analyst estimates are saying first.
Okay.
Oh, wow. Not much growth.
No,
3% earnings growth, 3% revenue growth.
Yeah.
I'm just going to jump to Stock Analyzer real quick and see if it's even. So because of what Mo said, I think he's right. With so much here, the growth coming from acquisitions, that really, really bothers me. So think about it this way. Let's say you had a small business, a gas station, and you ran the gas station really well, and you grew 10% per year in revenue. And your neighbor has a gas station, but they don't do as well. They grow at 3% a year, but they go buy another gas station, so it looks like their revenue doubled. And everybody said to them, oh my God, look how great they are. They doubled their revenue, and you only went up 10%. But really, you made your one gas station a lot more efficient and generated higher revenue growth than they did. They just bought their way into growth. And that's what we want to avoid. That's not natural growth. That's the reason we sit there and say, wait a second, they've spent in the last 10 years, how much?
Oh,
Mo?
man. I mean,
so
let's see here.
Call
ready?
it 18, 24, 29, 32, 62, 72, 73, 74, 75. $75 billion. $75 billion on acquisitions. That's a lot.
That is a lot.
And their cash flow in the last, yeah. I mean, they've generated a lot of cash flow, but it's. All right, let's do our stock analyzer tool here, Mo. You give me the numbers here, bro.
1, 2, and 3. I don't think they could do more than 3%.
Well, if inflation's up and they have to raise their prices because that thing's okay. Profit margin.
It's decreasing too.
Well, it just had 1 year of decrease.
Do 13.
I don't think 13 is reasonable. Well, that's only 1 year.
16, I was gonna do a big spread.
Oh, okay.
Yeah, I was
Go
gonna
ahead.
go 13, 16, 19.
See, but 16's even low for the middle area. Like to me, what about 14, 17, and 20?
Okay.
Okay, free cash flow.
I would do the same thing.
But even no, see, I don't agree, Mo.
Really?
Mo, look at their look at their last 10 years. They did 21.6, and now in the middle area, you're gonna put in the highest area, you're gonna put 20. I don't think that's fair. Like to me, I'd sit here and put 20, 21.5,
Okay.
and 23.
Wow.
Because remember, it's only 1 year of this big drop. In the last 10 years, they've generated literally consistent free cash flow. That's the reason I say that.
Okay.
Let's do 19, 21, and 23. How about that?
Sure.
Okay. PE.
I would almost 15, 17, and 19.
Okay.
Same for the price to free cash flow.
And desired annual return.
11, 13, and 15.
Okay. Hit the analyze button. Not even close. 60 to 80. High side of 100. High side. Middle price. And this is with our margin of safety in here. If you paid today's price, on the low assumptions, you're going to make 1%. On the middle assumptions, you're going to make 4.5%. On the high assumptions, 7.5%. Now remember, that includes dividends because you can't double count the dividends. Some people sit there and say, well, they also pay 2.5% dividends, so you add that. No. This is a cash flow analysis and an earnings analysis. What they do with that is completely up to them and is not counted as extra because then you're double counting the cash flow. So guys, if you like this, I have one favor to ask of you, two favors to ask of you. One, like and subscribe to this channel. Like this video, subscribe to the channel. And two, share this video with somebody who might find it interesting. Thank you very much for your time.